Welcome to Cash Flow Savannah, episode 33. Chandler, how you doing?
I am doing pretty good. How about yourself?
I'm good. I'm good. I am really excited that we were able to bring on this very esteemed guest today. We have Taylor Brugna. He is a CPA at Hall CPA. He's actually one of my accountants. So I've been getting to know him and they've been doing a great job for me. Today, we're going to talk about money and instead of paying it to the government, keeping it in your pocket. So the subject sounds a little dry, but I want you to know it's so important. Like, I don't even know if you can educate yourself enough on this subject. But we also talk a lot about real estate investing in general.
So, yeah, no, this is definitely one of those that I don't really like listening to, or I don't pay attention to, but I need to. I'm more into just like, oh, get into real estate, make money, blah, blah, blah. And then I don't even think about taxes. Um, but sooner or later, I'll start learning a little bit. But
Yeah.
no, really great information that I had no clue about until today. So,
Well, and one thing Taylor talked about a ton because Chandler kept asking him is flipping and wholesaling. And we have a lot of flippers and wholesalers here in Savannah. A lot of them are our very good friends. So I want you to know, like, I think Taylor kind of dove into tax strategies that a lot of guys aren't talking about very often. A lot of the information he shared on those two subjects, I had never heard. And I listened to a lot of real estate podcasts. So I am proud to say we are obviously the best in the space, right, Taylor? Like we're bringing information that no one else is.
yeah, no, not a lot of people talk about this. And I think that's one of the reasons that I'm not very informed either. Everybody kind of talks about, oh, I made this much, but oh, how much did you save in taxes? That's a big question. And
The big,
it's
big.
always been one that I've asked, but nobody's ever really been able to give me a good answer on. You always have different opinions, I guess.
Well, and Taylor also talks about how if you don't make a large sum of money, you can still save a ton on taxes. And I thought that was really fantastic. That was also another strategy I hadn't heard before because you hear about these big bajillionaires paying no taxes. Well, that's not very relevant to myself. Do you resonate with that, Chandler? I mean, I can't say that I've never paid taxes, ever not paid taxes.
Yeah. Now I get a little jealous of them when they say, oh, I don't pay taxes, but he kind of answered that a little bit for us today. But and it also helps that he is actually in the space and does very well in the space. So he's a good guy to listen to.
Absolutely. So without further ado, we're going to bring in Taylor Brugna with Hall CPA. Welcome to Cashflow Savannah, Taylor Brugna. How are you?
Good. How are you? Thank you so much for having me, Julie.
It's a pleasure. For those of you that aren't familiar with Taylor, he is my CPA, and I'm very proud to say that. I am here in Savannah. Chandler's here in Savannah. We both invest here in Savannah. Taylor, where are you? I know you are not in Savannah, but you do work out of Georgia and many other states.
Yeah. So our firm is called Hall CPA, and we are a virtual firm actually. So there's three partners. I am one of them, and we have clients actually in all 50 states. So I'm based in Dallas, but we have clients everywhere. We have staff everywhere. So we're covering the entire country, which is great.
Perfect.
Well, cool. So tell us a little bit of like what a CPA actually does.
Sure. So our firm specifically focuses heavily on real estate investors. That's pretty much all we do. We've specialized in that since the beginning. And the three major services that we offer that I really think every investor needs is one is tax preparation. So, of course, just getting those tax returns done on time, filed accurately. Two is tax strategy. So, tax strategy, kind of what that means is tax preparation is really just filling out a form correctly for what happened in the previous year. There's not much you can do at the time that your accountant is filing your return. Tax strategy is proactively planning throughout the year to how we can reduce your tax rate as low as we possibly can. There's a lot of cool strategies in real estate, so we really focus a lot of time on there. And then last but not least is the department that I'm in charge of, and that's our accounting department. So making sure investors' books are clean has a variety of benefits, but really two of the main ones is that one is that you get the access to information that you need to help make decisions. So you have clean financials, you can decide, do I buy the next property in this certain market? Do I have a lower occupancy rate in this county? Why do I have that there? And then secondly, another big benefit of accounting is that come tax time, come time to do tax strategy, again, the information is clean, really easy to understand, so that the rest of our firm can do their jobs and make sure that your tax rate is as low as we can, and again, that the returns are filed on time and accurately.
Okay, cool. And so you're currently in real estate, right? You've done some real estate investing yourself.
Yeah. So I started, so I will try to give you the short story of my real estate investing career. So my wife and I had an eBay business back in high school and college where we would sell like Nike, Adidas clothes at outlet stores. And we were very fortunate that it did very well. A lot of our customers were international customers that just didn't have access to those name brands that areas in the US do. But then after we graduated college, I went into accounting, she went into finance, and we just didn't have enough time to run that business. So I was looking for a passive investment kind of vehicle to park some cash. I found real estate and honestly just kind of fell in love with it. So I started with 4 cheap condo units in Tampa right when I graduated college. We're now up to 135 units, small multifamily, all 2 to 12 unit buildings, and really just um, extremely fortunate for how things have happened, but really it's kind of a boring story of just saving that profit, kind of property after property, doing cash out refinances as things appreciated, and just keep buying the next one. I haven't touched a dollar of that profit really until now, about 10 years later. So just being able to kind of grow that throughout my 20s was huge for me.
And that's all you and your wife. You bought everything, just the two of you. That's fantastic,
Yeah,
Taylor.
so there are a couple of partners here and there, but on certain deals, but we own, I would say, I don't know, 80% of it on average, something like that.
Well, I have to
Cool.
say, as an investor myself, I chose Hall CPA because you guys are all real estate investors yourselves and you get it. Like it's a complicated, thing. And I've seen it where you have to train your professional. And I don't want to train my professional. I want the professional to already know the info. And I love that you guys are all real estate professionals. Is everyone in the firm a real estate investor?
So right now, we've actually grown quite a bit over the past 10 years or so, where we have about 70 employees. So I wish we could hire every single person that has like a couple rental properties here and there. So I would say the majority are, which is amazing. And then if they're not, they also have a serious interest in real estate. And we make sure during the hiring process that they really have a genuine interest in this space, because all of us love it so much that we can train, we can teach people. We love talking about it. I'm on podcasts all the time. As long as they have the interest, we're good to go.
Okay. Cool. What kind of real estate do you have? Is it just condos, long-term rentals, or everything in
Yeah,
between?
yeah. So I have kind of first class is I've got 2 to 12 unit buildings. So that small multifamily space. I like to be in that like 500K to like 1.5 million range, because it's too big for the small guys, but it's also too small for the big guys. So I like to kind of specialize in that kind of middle market space. I do mostly long-term rentals. I've got a couple Airbnbs that I'm trying out as an experiment. I'm loving that so far. It's definitely more time intensive, but I am loving that. But they are mostly long-term rentals. I've got a couple of midterm rentals near a hospital as well. So
Cool.
um, all things trying out. So
How have you found most of your deals, Taylor? Because you obviously work full time. You aren't out beating the
yeah.
pavement yourself. What's your strategy for finding deals?
Sure. So when I first started, I linked up with a broker in the area, and we kind of just hit it off from the beginning. He was just starting out, I was just starting out, and we honestly just put a lot of trust in each other to really kind of start our businesses together. So he was my first property manager. He still is my property manager. But a lot of those deals in the beginning were on market. And the strategy that I like to kind of really employ, and it's not for everybody who's just starting out, is I try to make offers as aggressive and quick and painless for the seller as possible. So I typically don't do inspections. I do due diligence before on my own, very short kind of earnest money period or kind of diligence period, depending on what state you're in. Very short closings. I try to pay cash when I can. It's not always easy to do that, but that gave me a really good reputation in the Tampa St. Pete area where I could actually make on-market deals work. Now I've got sure 4, 5, 6, 7 properties that were off market, wholesale, things like that. But honestly, you don't necessarily need to have some crazy acquisition system to be successful in this space.
Yeah. I've seen a ton of real estate or just on-market deals come up lately that can possibly work that I've been looking at. I'm like seeing a lot more nowadays,
Yeah.
especially. So it's getting on market's getting popular again.
Yeah.
I've done just like you, Taylor. I got one agent that understood it and went after it, and then I became one. But yeah, same thing. A lot of my stuff has been purchased on market as well. And it's people don't they like the idea of off market. It sounds sexy, but when it's on market, you have the ability to A, take time to get financing, B, lowball them. It's not like, a wholesaler is going to say this is the price, period. Where on market, the price is just a suggestion. That's my favorite kind. So
Exactly right. Exactly right.
Now on to I know you talked about an eBay business, and I guess I've had a similar like style to you where I've had a side hustle of doing like Facebook Marketplace. I guess that's the new thing to eBay.
Sure.
Um, as far as taxes with that with cash, did you have to deal with that a lot or no?
Yeah, so not necessarily cash transactions because all eBay was it would just go straight to PayPal, and then PayPal obviously all electronic, all transferred just automatically. But what I will say is that that space where I was basically flipping items was not very tax efficient. And the reason why it wasn't tax efficient is because it was self-employment income, subject to extra self-employment tax at a rate of 15.3% extra. So I think a good parallel to real estate investing is that a lot of investors who I work with, they'll start flipping deals, they'll start wholesaling deals. And all of that's great, but what happens is that it's subject to a much less favorable tax rate than long-term rentals, than short-term rentals. So what I did and kind of what I see most of my successful clients do is you take an active income type business to generate cash, generate that kind of foundation to get started, then you can move on to something a bit more tax advantageous like long-term rentals. So I was getting crushed in taxes in the beginning. Now with long-term rentals, depreciation, all that good stuff, it's a lot more favorable that way.
Well,
Okay.
Taylor, I first heard about Hall CPA because I'm in the short-term rental world. That's a big part of what I do on the day-to-day basis is property management and real estate sales. So that's where I first heard about your name. So just for our listener, what's the difference in tax strategy and tax, however you say it, for short-term rental, an owner of short-term rentals versus an owner of long-term rentals? Because we know there's a difference there. There's passive versus active, but give us some info there.
Sure. So first, just a quick disclaimer that this stuff is extremely nuanced, and I'm going to give just very broad kind of starting points. And then, of course, if there's any follow-up questions, things like that, I'm sure Julia will kind of give you my information, things like that. But the main difference between long-term rentals and short-term rentals is that long-term rentals are generally treated as what's called a passive activity. And when you have a passive activity, now real estate's eligible for a depreciation no matter what. So the general rule of thumb is that most rental real estate ends up in a loss position every year on your taxes. Now, if it's passive, it can't necessarily be used against other active income. And other active income might be considered like a W-2 job, or maybe you have a business, or maybe you're self-employed. Passive losses can only offset passive income. So if you're doing long-term rentals and you're not a real estate professional, really what that means is that if you're losing money on some rentals, the only way to really offset other income is if it's from rental properties as well. So like you might have one rental making money, one rental losing money, and that's how they offset. So that's long-term rentals. Now, short-term rentals, there's this strategy that our firm has really been one of the pioneers on, and that's called the short-term rental loophole. And basically what that means is that there are ways to qualify a short-term rental where you are what's called materially participating. And if you are, you actually can take the losses against other active income. So there are scenarios that if you have a lot of depreciation, if you have a lot of furniture that you bought and you're expensing it, things like that, and it puts you into a loss position, you might be able to offset that loss with a W-2 job from your accounting job, or you're a doctor, you're a lawyer, you're a property manager, whatever the case is. So that's something really powerful about short-term rentals.
Wow.
That's interesting too, because a lot of the money made in real estate is on the appreciation side. You know, we obviously cash flow, but cash flow's gotten tighter. And here in Savannah, we used to be a cash flow market, not an appreciation market. And now we've flipped. We're way less cash flow and way more appreciation. So in what you're saying with the short-term rentals, let's say a professional like a doctor or a lawyer, they buy themselves a short-term rental. Like you said, they put money into it. Maybe they put in new floors, some paint, buy furniture, and they have now lost, you know, $30,000 this year. That 30,000 loss can go towards their income, which is, you know, great. That saves them 10,000 in taxes. But for, let's say someone has a W-2 and they have long-term rentals, and they on paper, let's say they do a rehab or whatever, they lose $20,000 on a long-term rental, but they have a W-2. Do they lose that $20,000 that they lost, or what happens to that loss for someone who's not a real estate professional or who's not using the short-term rental strategy?
Great question. So one of the most important forms on a real estate investor's tax return is called Form 8582. And that's if you're a long-term real estate investor most of the time, or if you don't meet those tests that I was talking about earlier, qualify for that loophole. And what that is, it's basically a running tally year over year of your suspended losses. And what suspended losses means is that if you had a bunch of depreciation or a bunch of expenses and you couldn't offset it against other income, it just carries forward into the next year. So the great news is that if you're losing on paper, it's not necessarily gone forever if you can't use it. It's carried forward into the next year until you can use it. And the two conditions, generally speaking, the two conditions of when you can use it are, like I mentioned earlier, one is if you have other passive income, but two, if you sell the activity as well. So like, let's say you have a property that's been losing for years, it carries forward year after year after year, all of a sudden you have a $200,000 loss built up over the years, and you sell that property, that will actually net out with your kind of calculation for your final capital gains bill as well. So there are benefits to having those losses pass through for sure.
For that property, or you can sell 123 Main Street and use the depreciation loss from 203 Left Street.
So it depends. It depends on how the activities are grouped together. But generally speaking, if they're not grouped together, then it's just that one property it's used for. So it just depends though, because there are scenarios that it's both.
What if you sold it to one of your other entities?
So generally, anytime you're selling to like a related party or anything like that, there's going to be completely different rules that are applying. So generally, these things, it's always advisable that if you have some kind of nuanced transaction like that, make sure you run it by your CPA first, because a lot of the standard rules do not apply.
Yeah, wow, my mind is getting blown right now. I have 4,000 questions. So I want to ask, the first question that's coming to mind is, so for tax strategy, is it better to have a short-term rental that's getting a loss and a long-term rental? Like, is it better to, yeah?
So it's a great question. Again, I think it is going to be highly dependent on your specific situation. So I think the short-term rental tax strategies that are available to us are absolutely fantastic, right? If you buy a property in year one, you can get a lot of depreciation in that first year. You can really take a big loss. But going forward, remember that short-term rentals are supposed to be operated as a relatively high cash flow business, because you have the reason why we're doing all this extra work over a long-term rental is to generate that extra few points of margin. And what that typically leads to is, after year one, that you do have a big loss, years 2, 3, 4, 5, 6 are probably going to be profit years. So in that case, having the short-term rental loophole may not do that much for your tax situation beyond that first year that you bought it, and you get that big depreciation deduction in year one if you do something called cost segregation. Now, long-term rentals, it's a little bit more of a slow and steady approach where it may be beneficial to have that if you have other rentals making money. So I hope that helps kind of answer it. There really is no one size fits all. I think they're both super beneficial. It just depends on kind of what your other income and situation looks like.
Okay.
Taylor, I'd like to ask you about cash because we all, if you're in real estate, you're going to be dealing with contractors and pretty much anyone you deal with. It could be a cleaning lady. They would love to take cash over a check. They would love to not get a 1099.
Sure.
How, as an accountant advising someone like myself, maybe some people want to be paid in cash, some people don't. Like, what is your advice for working with cash?
Sure. The advice is honestly to not do it. And let me just explain why. So first things first. So the IRS basically has uh, the burden of proof on the actual taxpayer if in the event that you're ever audited, right? So let's say you have a $10,000 expense on your rental property for whatever reason, and the IRS says, "Hey, what is that expense?" It's up to you to be able to prove that you had a valid expense. Now, if you pay cash, your bank activity is really just showing $10,000 out of your account and nothing else, right? I could have bought a car with that for all we know. So that's a really key reason on why I don't love cash. But another reason is the IRS also mandates that anything over $75 requires a receipt. So if you're buying a few bucks of materials at Home Depot or something like that, the IRS realistically would never say, "Hey, prove to me that you just purchased these nuts and bolts," or whatever the case is. But if it's a $200 purchase, they actually might ask you for a receipt. And whenever you're giving cash, it's kind of awkward to be like, "Hey, by the way, can I just scribble down that I paid you $200 and you sign it here?" So realistically, I don't love it, and especially with Zelle, Venmo, ACH right now, it's just so easy to pay people electronically and have a really strong paper trail.
Well, I want to take it deeper because I need help with this. So I run a pretty good property management company here in Savannah, and I also have a bunch of construction zones myself as an investor. And my project manager, he does end up paying out some in cash, and he does exactly what you just said. He'll make them give him a receipt and sign it. This is a good example. Trash. It's really hard. Like I had this duplex that was gross. I mean, it's fabulous now, but there's trash everywhere. No one wants to touch any of it. We even had an old toilet sitting out there. My project manager, Ben, needed to get a guy to come pick up all the trash and haul it away. And there's no guy, at least it's a small job, it's not like a get junk thing, but he did he gave him 600 in cash. He made him sign the receipt and then he turned over to us for reimbursement. Is that fuzzy? Like, don't do it. What are your thoughts on that? Like in the
So,
industry, you're kind of stuck sometimes.
keep in mind, I mean, this is obvious, of course, but cash is always a valid form of
Right.
currency, right? So what I would say is doing it without documentation is it's pretty much impossible to prove that it actually happened. If you have that documentation, it should be sufficient. Is it perfect? No, it's a lot less clear to an auditor as if they had a bank statement with a clear description of where it went, proof that it got sent somewhere. So if you have to do it, I understand it's part of the business, but I try to avoid it the best we can. And the other thing that's interesting too is, so I'm also on the accounting side here at the firm. It's also really hard for our accounting team to categorize those transactions unless the receipts are uploaded accordingly, because then it kind of spirals not only into like an audit perspective, but also, oh, what was that expense? I forgot what it was. It was 6 months ago. I have no idea who I just gave $300 to, and then you don't know what it was for, and then you have worse data. So there's pros and cons.
Let's say Chandler is a trash pickup guy and he has a couple thousand worth of cash sitting around. Can he work with that pretty well? Like, what is your advice? Who's someone who typically gets paid in cash? How would someone like do that legally and declare things like that?
Yeah. So I think a common misconception that a lot of people have about taxes is that just because you didn't receive like a 1099 or a W-2 or like some kind of tax document that shows that you have the income, unfortunately, that doesn't really matter. The IRS still, in their eyes, of course, it's still income, and you have to report that as if it was a completely official electronically filed form or something like that. So there really honestly is no difference. If you receive cash or you receive a check from a huge, large employer that gives you a W-2 or something like that, there's no difference in the IRS's eyes. Now, in reality, do people, test that line? Of course, but it's certainly not recommended.
What do you see landlords doing that are taking cash as forms of payment for rent? I am extremely opposed, and I don't do it just because I fear the auditing, but I know this happens every month.
So I think for anyone listening, I think that's absolutely insane, to be honest. So to just give you some perspective, I have a client who has thousands of single family homes. So talk about an administrative burden of just dealing with leases and paperwork and renewals, things like that. They will not accept cash at all. The point of me saying that is, if they can do it, you can do it. It's just simply not worth the administrative headache to take cash. A lot of people now in 2024, wow, it's the new year. In 2024, they aren't even accepting checks. I try to avoid even a cash is non-negotiable. I don't accept cash. I don't like to accept checks either. The only time I accept checks is when it's from a housing authority. I've got like one or two out of the portfolio that are Section 8, and they will mail a check. But everything else I do electronically via a property management software for so many reasons. It's more efficient. It saves me time. There's a better paper trail. It's automated. So that's the way I like to run things.
A lot of property management systems are set up now to where you can take cash by having them go to Walgreens and handing them the cash, and then you get the money electronically. And so
it's a great point. And I think every one of the big softwares now has that now. Buildium, Appfolio, Yardi, Rent Manager, they all have it. Buildium has a feature, I think it's called like Pay Near Me, and you basically get like a barcode. It's really cool. Like you get a barcode, the 7-Eleven or a money order place will scan it, they'll take the cash, and then that automatically gets uploaded to the software. So like even that, if I did have a tenant who really wanted to pay cash, I'd probably look into a system like that because it's just so much more efficient. So,
All right, so I have a question for you. I've always asked this question. I can't really get an answer.
sure.
So I listen to a ton of podcasts, and all these big dogs are like just a typical W-2 worker that makes 60 grand a year is paying more taxes than me, and they have thousands of units.
Yep.
Is this just something they're saying? Is it true? And how in the world are they doing it?
Yeah.
If it's true.
So it could be true, and I'll try to keep it as simple as I can. But basically, one of the things we talked about was the short-term rental loophole, right? And that allows you to take losses against active income. There's something else that's a similar kind of valuable tax strategy in the real estate space called a real estate professional. And basically, again, there's a lot more rules, but if you spend 750 hours in a real estate related trade or business, it's more than half of your time, you could be what's considered a real estate professional. And what that means is that all of your losses from depreciation from real estate can be offset against other income. That's this valuable strategy that we're trying to unlock in the real estate space. So if you have 1,000 units, and let's say you just bought a 200 unit building this year, you have this massive amount of depreciation in year one. That's generally how investors are doing this strategy. There's a huge loss in year one. So you have 1,000 units that make money, that they also have depreciation. It's not as big, but there's still depreciation. You have 200 units that have this huge loss. And then what happens is actually, if you do it correctly, it's really hard to do, but they can offset almost dollar for dollar if you buy something big enough, and then your tax bill is zero. So it's a little gimmicky on how a lot of these influencers and marketers describe it, but in a nutshell, yes, it is possible. It's very difficult to do. It's easier said than done, but it's doable. So
what you're saying, Taylor, and I don't mean to dumb down what you're saying, but I'm dumb. they need to pretty much buy a new property every year in order to make that happen. It's not going to just because they have 1,000 units, they have no taxes. They're having to constantly work
Yep.
to depreciation.
And one of the most valuable strategies in the business is called cost segregation. And basically, what that is that you're taking pieces of the building and you're accelerating depreciation. So if you buy $1 million building and you do cost segregation, you might get a $300,000 loss in this year. If you have a normal year, you might get 40,000, you might get 30,000. So there's a huge delta in the first year depreciation versus other years. So to answer your question, it only works if you can buy something pretty significant in size every single year. And every year that you operate, it gets harder and harder because you're making more money. So I think people dumb it down a bit too much and say, "Oh, I never pay any taxes." That's not true. It's a really complex strategy to get there, and it takes a lot of capital. It takes a lot of money to be able to actually implement that strategy effectively. So
Yeah, I just hear it all the time. I'm like, I don't know. Are y'all really? So
right,
I just wanted to ask you to see what you had to say about it.
yep, sure,
And another question I want to ask, we're throwing it around just for the listeners. Like, can you explain how depreciation works?
yeah, absolutely. So I'll just use a residential long-term rental because it's the easiest to understand. So generally, so when you buy a building, let's say it's $1 million, that's the easiest number to use. It's $1 million building. The depreciation schedule assigned to that building is generally 27 and a half years. So what that means is 27 and a half years is roughly 4%. So every year you get a 4% deduction called depreciation expense. And it basically what it does is it'll help offset your rental income and all of your other activities from real estate. And that's what will make real estate pretty tax efficient in the sense that you're not going to have a big tax bill from a rental property every year because of that 4% deduction that you get. In year one, again, it could be bigger, but in years 2 through 10, it's like right around 4%. So what depreciation how it's sometimes a misconception though in the real estate world is that people think it's like this tax-free benefit that you never have to pay back. And as I've learned at this point, and I'm sure everyone has learned at this point, there is no free lunch, right? So why I say that is that every dollar that you depreciate, it lowers your basis in that property. And what that means is that when you fully depreciate something and then when you go to sell, you're paying a depreciation recapture tax on what you've taken over the years. So it's still very beneficial because you saved money in year one and in year two and year three, and you may be paying some of it back in year 10. So that value of that savings compounded over time that you've invested, you've done other things with is really valuable. But it's not a free deduction. You pay it back as you sell. So just keep that in mind.
Okay.
I have a
Yeah,
complicated. Oh, go ahead, John.
no, I was just saying it's an interesting game. It's very strategic. It's tough to understand. Like I try to learn about it, but it's like, holy cow, what in the world?
There are so many strategies you can. So after the 27 and a half years are up, you don't get any more depreciations. So you might have to do a 1031 exchange into another one and put more money into the deal to get more depreciation. You might need to pay more tax at that point because that a deduction is gone. It might be a good time to sell at that point. I mean, it's just that there's a lot you need to plan around it. So.
Chandler and I had a situation a couple years ago, which I thought was very interesting. Not for the buyer, but there was a guy here. He had an apartment complex, and of course, everyone wants those, and Chandler and I are no exceptions. And this guy had, my understanding is it's a dumb choice, but he had moved it into an S corp, which I keep hearing is terrible. You don't ever want to move it into an S corp. But he really was intelligent on his own end. He was one of those sellers that only had his own best interest at heart and really didn't give a flip. So he had this very desirable asset that everyone wanted, including Chandler and myself. And he flipped it to an S corp, and he had done a good bit of the depreciation on it. Well, he didn't want that recapture. So he didn't want to lose, he wanted all the money in his pocket. So what he did was he was shopping it around Savannah and saying, I'm not going to sell you the building. I'm going to sell you my shares. And I mean, we walked away quickly once we realized what he was doing, because had we bought that, we would have bought shares of an already depreciated asset, and there would be very little tax money left for us. And then we also have an asset in an S corp, which you don't want it in that. But I thought it was very interesting. I actually learned a lot on that transaction, but I thought, wow,
Yeah.
what are your thoughts on that?
A couple of general things around that. So, one, generally buying into an LLC. I mean, there are situations that it works, but there's also a huge legal risk to that as well, because you're also assuming the liability of that company for years prior that you have no idea what happened. Maybe there's an active lawsuit going on that you have no idea about. So that there's a really extra layer of diligence that honestly stresses me out too much. But also, yes, to your point, anytime you see a situation like that, you definitely want to be able to start new depreciation over, be able to just take a fresh schedule based on what you've actually paid. So that strategy would not be something that we would ever really look into or recommend. Selling a part of an LLC as a building is not usually something that's done. So
Yeah, I asked my real estate attorney, and he was like, run, run, run. And I was like, okay.
yeah, we actually never see that because it's just not something that's ever appealing to a buyer. So like I have very limited experience with that because it never really happens.
They got it done. They sold the shares. This guy bought it, and we met him. I was like, wow, dude.
Interesting.
Yeah. So I want to ask, is there like a specific type of real estate that you like to buy that's better with taxes, or all pretty much the same, certain different strategies?
Great question. So I think a common thing you'll hear from us is that you don't necessarily want to drive your investment decisions with tax decisions. It's a very key part of your business, don't get me wrong, and that's why we're employed. But I wouldn't necessarily pick an asset class because it generates more depreciation than another. And that being said, there are asset classes that do generate more depreciation, and it's because more of the components of the property are eligible for what's called bonus depreciation. And that's what I was talking about earlier with that cost segregation, is that you're picking out pieces of the building that are eligible for a special tax deduction, basically. So a couple of properties that are the types of properties that are known to be really good for that, mobile home parks. Mobile home parks are really good for that. So like that's something that if you see a lot of these kind of syndicators out there, you see them on LinkedIn, something like that, you'll see that they advertise usually a higher rate of depreciation. That generally is true because a lot of the components of a mobile home park are not structural, and then they're eligible for a shorter depreciation curve. So things like that. Self-storage is another one. Mobile home parks is another one. Anything kind of rental related, like apartment buildings, single family homes, all of that is generally pretty similar. So I would think that's really the only couple types of property that are relatively different.
I've heard that about mobile home parks. It's like one of the best like tax benefited things in real estate, which really surprised me. I was like, what, really?
It
Yeah.
surprised me too, because they don't own any of the homes. They just pretty much own the land. So how can you give us a little more info on that? I've never heard this.
So there's differences. So a lot of mobile home parks, people do actually own the homes. So if you're talking about lot rent situation, then it's different. There is less depreciation.
Okay.
But one of the things that is really valuable in a mobile home park, and it's eligible eligible for that bonus depreciation, are the utility connections. So like the actual connections from the home to the sewer system or the plumbing or whatever the tanks are. I'm not an expert on the actual how it works, but those components are eligible for a lot of bonus depreciation. So
It's so weird how that. Wonder why those components are make it special.
yeah, it's very interesting. But the general rule of thumb is that if it's structural, so if it's something that's really like a permanent structure affixed to the property, so if it's the actual structure, if it's an HVAC unit that you can't move, if it's something like that, framing in the walls, that is your 27 and a half year property not eligible for bonus depreciation. But you might have personal property that can be moved. So that's something that could be like appliances you can pick up and move, right? flooring that's not glued down, like the click and the kind of locking vinyl plank, that's eligible for bonus depreciation. Some utilities improvements, like how I was talking about in the mobile home parks. So it's extremely nuanced, and that's why there are actually separate firms other than CPA firms that just do cost segregation because of how complex it is. So
Wow. I would have never. That's crazy.
yeah, yeah, yeah.
So, what are some? Go ahead, Julie.
What's your suggestion for a guy making 50,000 a year with a couple of rentals? What's your best tax advice for that guy? The small, regular Joe real estate investor who doesn't have $1 million to invest.
Sure. Sure. So the interesting thing about getting started in real estate, if you're in a lower income bracket, and I don't mean lower, but just for the purpose of this IRS test, it's anything under 100K. And basically what that means is that they have this special exception on those losses that I was talking about earlier. So if you have long-term rentals, do you remember how I was saying that if they go into a loss position, that you generally can't offset them against your W-2? If you make under 100K, you actually can up until 25K of loss. So it phases out. It changes every year. I mean, I don't know if the allowance has changed, but it's 100K to 150K. It starts phasing out. But if you're under 100, you actually can benefit from it. So the best advice I would have is it's difficult, but try your best to save as much as you can. Start slowly. 1 or 2 rentals is going to have a huge difference on your overall financial situation, and then over time it becomes easier and easier. It's just a snowball effect. The first one is going to be the hardest. The second one is still going to be really hard. 3, 4, 5, 6 become a lot easier than that. So.
Well, people don't realize we've just learned to accept it, but what you pay in taxes are the most money you spend in your lifetime. And we just accept it because we're so used to it, but we're working a lot of our lives just to pay taxes. And so if we can really come at this with a good tax strategy, we want to do it anyway. We want financial freedom. We want all the things, but don't forget this very important component, which is saving on taxes, because everything I don't send to Uncle Sam, I can keep in my pocket and use to buy more real estate. And that $25,000, that's a down payment right there. I mean, that's a huge asset to someone, not having to pay that in taxes. So I really appreciate that.
And then the IRS is smart too, because like a normal W-2 job, right? They force at the employers to withhold every 2 weeks. Of course, as you know, if you make $5,000 a month, you're not taking home $5,000 a month if you're a W-2 employee. So it's almost like you kind of forget about it because it's being submitted to the IRS. But your opinion on that changes quickly whenever you get into something self-employed, because when you're self-employed, you don't necessarily, the burden is on you to remit to the IRS quarterly if you have to, or things like that. And you really start to realize how much you actually pay every year. So I totally understand. It's the majority of people's largest expense. So it's a really important one.
Okay, so for a W-2 guy, and I don't mean to hog the conversation, but let's keep with a W-2 guy making less than 100, he saves 25,000 in taxes because of his real estate. Well, his job doesn't know he has that real estate. So is he just going to get that back in April? Or what is your strategy for a W-2 guy who does have rentals?
Yeah. So you can play around with your withholdings to withhold less if you'd like. I would say it's not the most common. I feel like generally what happens is that you just get a large refund check at the end of the year, which is not great, but I would certainly take that over paying a large tax bill, right? So it's definitely better to have rentals than to not if you're in that bracket for sure.
So, can you tell us a little bit about just some of the successful people that you've had and some of the least successful people that you've had and some great stories?
We love stories.
Sure. So I've seen, I'm in a very unique position where I've seen probably thousands of people's financial statements at this point. It's a really cool job, especially for someone that is so interested in real estate, kind of without the accounting and tax piece as well. But what I'll say in general is that I think there's a lot of successful house flippers out there. I think there's a lot of successful people who can wholesale deals. I will say, though, that it is a lot harder to make money in those spaces consistently and at scale. So there are very few people who are flipping 10, 15, 20 houses, 30 houses a year who are consistently making the margins that they need to, because it's a really tough business. And kind of like I was saying earlier, is that a lot of people make the mistake of not looking at returns after tax. So if you have that additional self-employment tax on the flipping, on the wholesaling, it becomes really hard if you compare that to a relatively passive long-term rental or a relatively passive with excellent property management, short-term rental. So as far as most successful, I think it's those family-owned businesses who have rental properties for years. They keep slowly but surely adding on to their portfolio. All of a sudden, one day they look up and they've got a very significant portfolio over the past 10, 20, 30 years. And they have cash flow forever that they've really built up and have done really well with. I say family-owned business too, because sometimes what I see as well is that there's a group of, now not all syndicators are bad or anything like that. There's a lot of excellent ones that we work with, but some of them have high fees. So kind of what a real estate syndicator does is they're raising money from a group of people who are not involved in real estate really to go buy a bigger property. And how they make money most of the time is acquisition fees and development fees and management fees and things like that. Now, not everybody operates like that, but those people, again, very similar to flipping, is that it becomes a job because they have to rely on those fees to pay bills. So if you take anything from that, the most successful, in my experience, are the ones that have assets with low debt and they hold them really long. The ones that are less successful are the ones that are still building to get to that point because they have to kind of rely on that paycheck month over month. And if it's either through a new flip acquisition or a new deal, they have to generate a fee on to pay the bills, things like that. So hope that helps.
Interesting. Okay, I'm going to take the conversation left. What are your thoughts on hard money affecting real estate deal?
I think it has a really valuable place in the business. I think there are a lot of deals that are complicated and you can't really get done through any other ways of financing, right? So I can give you an example of one that I had to do that I refinanced quickly after, but it was a crazy story actually. A investor in Tampa was running a Ponzi scheme effectively, where they were one of the bad syndicators that I'm talking about, that they were taking people's money, they were buying properties, but then they were taking more people's money and just paying returns kind of with that other money. And then they were taking a portion of the money and buying Ferraris and private jets and all that. So they were not a client, but I found an auction of a property that they were forced to sell. So a judge was selling the property, and basically there had to be a very quick closing. It was an auction property, so it had to get done fast. So I couldn't get a normal bank to do it. I didn't have enough cash because it was a relatively large property. So a hard money lender came in and saved the day. Now, was it expensive? Yes. Am I still, did it all pencil out correctly because I was able to refinance quickly after? Yes. So they're really valuable. The interest is still tax deductible. I would say that you don't want it to be permanent financing, that's for sure. I think that's also where people who flip houses are in a lot of trouble, is that they get into a routine of paying 10, 12, 14% every single month on every property they have. And it's really hard to kind of do that long term. So
I've had a lot of friends get in trouble with hard money, and you know, that they haven't necessarily lost the properties, but it can very quickly eat up your returns. And what we're talking about today is money. I mean, we're not buying real estate to get poor. We're buying it to have assets and live off of them. So yeah, I'm always very curious. I've never used hard money. Thank goodness I've been able to get lines of credit. So I'm my own hard money lender and I don't charge myself points. But I also recognize that, like you said, there's a time and a place for it, but very short term.
Yeah, the advice would just be is that if you have to use it, that's perfectly fine, but don't make it a long-term situation. If you're flipping a house, right, the single largest driver of profit, generally speaking, on those flips is time held, because you have holding costs, you have your interest, taxes, insurance, utility, that adds up. So if you can get out of that hard money 3 months, 6 months, fine, it's not a big deal. But the clients I see that are in it for 18 months, 24 months, they're extending it. It gets really hard to make it work. So
Yeah, that's tough. So let's say for a flipper, I kind of want to talk about flippers.
sure.
Or so for taxes for them, like, is there a certain strategy that you like to use with a flipper or wholesaler?
Yeah, great
Uh,
question. So I may have been too harsh on flipping, just comparing it to rentals. So I like rentals better from a tax perspective, right?
I think everybody knows that too. Like
Right.
it's just
But
true.
flipping can still be an incredible way to build up your
Yeah.
capital base to start doing that. So self-employment tax is the biggest kind of downside on the tax side of flipping. So how you avoid self-employment tax is how we were talking about earlier, that holding rental real estate in an S corp is generally a bad idea. If you're flipping houses, it's a little bit different.
Oh,
If you form an S corp to flip houses, there's a way that you basically pay yourself a salary, and that has self-employment tax attached to it. But then anything you don't pay yourself a salary on and you just take distributions, that's not subject to self-employment tax. So the best strategy for a flipper is to, after a certain point of income, it's generally like 60, 70, 80 grand, let's say, a profit, you want to form an S corp. And the reason for that is because once you pay yourself that reasonable salary that I'm talking about, whatever is reasonable, there's a whole series of tests. After you pay yourself the rest, that's not subject to the 15.3%. So the single best strategy is that. The other one that our most successful flip clients do is, in addition to the flipping, they own rentals. So
Yeah.
it's really S corp, own rentals, and that's really the two very simple strategies for it.
I have never heard this. That is fantastic. So the flipping business is an S corp, and then the holding of the rentals is in an LLC. Is that correct?
Correct. Yes.
Very interesting. Wow, I never had heard that, Taylor. You got me.
I'm glad you learned today.
Very cool.
You got
Awesome.
me a lot of stuff nowadays. So I just want and explain like an S corp and how that works. And is it tough getting funds out of that? Or is it just explain that?
So how an S corp generally works is everything typically starts as an LLC. So you start your business as an LLC. Then what you can do is you can file a form. It's called the 2553, and you elect to tax the LLC as an S corp.
Hmm.
The main condition of an S corp, for the purposes of this conversation, the main kind of change is that you have to pay yourself that reasonable salary. Now, there's a series of rules based on what you're doing that you kind of get that salary number. But other than that, it's really the same. The only difference is that you're setting up payroll.
But Taylor, what if the company isn't making money yet?
So if it's not making money, then ultimately you're not going to have that self-employment tax problem. And then I would just suggest to leave it as an S corp. I mean, as an LLC, excuse me.
Okay. So you wait till you're very profitable and then move it to.
Right. And I said 60 to 80K for that reason, because then it has to have a tax benefit. And then also it's more complex to set up payroll.
Yeah, there's a guy, I have no idea if you know him, but he's on one of the bigger pockets. His name is James Daynard, and he flips millions a year. And I'm sure that's very interesting. And I'm always like, how in the world? Because you don't hear a lot of very successful flippers, but one of the other ones I follow, which I really love, his name is Jamil, and he's been buying apartment, just like what you said. He's a big flipper, but he's been buying apartment complexes just to kind of help his taxes, because he was just getting killed in taxes. And I was always very interested. But anyway, but thank you, Taylor. Thank you so much for coming on. I've learned a ton. I can't say enough that I don't care what profession you're in, you need to focus on taxes. But especially with real estate, it can get so complicated. And I'm very honored to have you and your company on my team. And I just want the listener to remember, a fool and his money are very quickly separated. So having someone like Taylor and his firm, or someone else of your choosing, in your back pocket, to help you manage that money and pay less taxes, is just so, so important. So thank you for all the knowledge that you brought. We really appreciate it. Can you kind of tell our listeners how to get in touch with your firm?
Yeah, no, I appreciate that. Thank you so much for having me. So www.therealestatecpa.com. And then there's a big become a client button. If you want to talk to us, you can certainly fill out that form. If you're interested in accounting, you'll probably be in touch with me directly. If it's tax strategy and tax preparation, there's a couple of other great folks on the team who you'll be put in touch with as well.
Well, and I really learned a lot about you before I hired you guys. I wanted to know who I was dealing with, and I listened to the podcast, which is fantastic. I couldn't take it for more than a few months. I just am not that interested in taxes. I'm sorry. I love you. Sorry. I got it. After a while, I was like, okay, I get it. But anyway, for anyone interested in learning more about tax strategies and you want it for free, I highly recommend the podcast.
Yep, it's called the Tax Smart Real Estate Podcast. So we're very fortunate that it's kind of blown up. We've had millions of downloads, but it's a very nuanced. If you're interested in this stuff, highly recommend checking it out. I am biased, but it's one of the best for sure.
It's very good.
Cool. Well, thanks for coming on.
Thanks, guys. It's a pleasure.
Well, thank you for listening to this episode of Cash Flow Savannah with Taylor. I really enjoyed this episode. What about you?
I really enjoyed this episode. He taught me a few things, and I talk accounting quite frequently with my husband, so I'm really proud to say that I'm going to tell him a few things when he comes home from work today. So I'm excited about that.
Yeah, I think I'll be talking about it a little bit more. But if you do have any more questions for us or any topics, please comment below. We just want what you want to listen to. We want to talk about and get some people on that are know the space really well. Please comment below what you want to listen to next, and also please like and share. We would greatly appreciate that, and we will see you in the next episode. Thank you.
Bye-bye.